Hey, it's Rick with your market update for Monday, October 24th. Our risk model is improving quite nicely, even to the point where you could consider starting putting a foot in the water and taking some positions. Not with full exposure. Don't know if any of you watched my weekend series on building a portfolio, but the in the section on position sizing, at this point, I would recommend no more than a 25% um, uh, opening position if you're an index or a sector investor. So, assuming you have a $200,000 account that's in cash, it could be appropriate to put as much as $50,000 to work, um, either all in one index or as I did today. I took 5 equal positions in a couple of indexes and some sectors, and I'll get to that in a minute. But things are definitely improving. It is a little early, obviously, but nevertheless, I think it's time to just put a toe in the water and get started. Looking as we always do, starting with the S&P. We've had a nice move after the follow through day on Friday, another nice move today, but we're bumping right up against the 50-day moving average. So I expect this could result in a little stall here for a day or two, and in a perfect scenario, we just stall here, stay inside, have a couple of quiet days. And we do have some big earnings this week. I think Google, Microsoft, Amazon, Apple, I think all report earnings. So it actually might not end up being a quiet week, but a really good scenario would be 2 quiet days. And then one of them announce really good earnings and we come ripping out up to here. So that's what I'd love to see. But we're now above the 8 and 21-day moving averages. And even the 21-day is now starting to tick upwards. So this is a positive sign. We can put on some exposure. Qs are not quite as strong. They're still below the 50-day, but closed in that range. They've closed above the 21-day. In my model, I showed the 21-day as being flat. You could argue it's starting to curl up. And clearly, if we stay in this upper half of the range or go up a little bit more tomorrow, this will also curl up. So this is a good sign. Small caps, again, not quite as strong as well. They were only at 0.4% today, where the QQQ and SPY were up over 1%. And then Toronto was only up a snick, 0.2%. But it is also bumping up against its 50-day moving average. So the positions I did take today, looking at staying with Toronto, I took in the Canadian dollar account, I took HXU, which is a proxy for the Toronto Exchange, except this one is 2 times leverage. So you can see today this moved up 0.5%, whereas the XIU moved up 0.21. So they should be fairly correlated at 2 to 1. So the risk on this is 4%. My stop is underneath Friday's low. So if we go below that, the risk is about 4%. On the US side, I took 5 equal positions for half of the account. I'm a little more aggressive than I'm recommending for you guys, but so half the account is now invested with equal 10% positions in 5 instruments. The first is UPRO, and this is equivalent to the SPY, but it's triple leveraged. So although I have a 10% position, if it goes up, it goes up 3 times as fast. So it could be argued it's equal to a 30% position. So that's the first one. Second was EWI, which is an exchange traded fund for Italy. And why intrigues me here is we've now gotten above the 8, the 21, and the 50-day moving average. It closed above it today. And again, I can maintain risk at 4% and keep my stop down here. The same thing with the EWG, which is the German market. And again, it closed right at the 50-day moving average, arguably maybe a tick higher. So same thing, I can contain risk at under here, which is about 4% away. And then two traditional EFTs, JETS, which is a proxy for the airline stocks. Again, it's above the all three of the faster and medium term moving averages. And XME, materials index, no, metals and mining, I'm sorry, metals and mining index, which is actually just right at the 200-day moving average. So this one's probably the stronger of the group. Yes, hanging around the 200-day moving average. So again, while I have 5 positions, my risk on each is 4%. And so by putting half my account into these, if they all stop out, the maximum impact to my account balance is only 2%. So we can handle that kind of a loss quite easily and recover from it. So if you were to put 25% of your account and spread it the same way through 5 instruments at then your total exposure is only 1%. So it's a good risk reward. Looking at these ETFs, it is interesting, just as from a teaching perspective here. I'll go to Google, or if you go to a website called MarketWatch, I can type marketwatch.com. It's a free service. They do have a paid service, but I've never really looked at it. But where I use this is you can look at these various ETFs. And if you just scroll down a bit where it says switch quote, I'll just put in the JETS. And then scroll down a bit and gives you the holdings. So you can see what stocks make up this particular ETF. And here we are, top 10 holdings. So this is obviously airlines. So Southwest Air, Delta, American Airlines, United Airlines. You can see it's no one stock is more than 10% as this ETF, which is it is important that they do stay fairly diversified. So there's that. If I just go back, look at XME. Metals and mining, it's a hodgepodge of holdings. It's a hodgepodge of ATI, which I think is steel, energy, uranium, steel, commercial metals, which is not sure what it is, US Steel, Reliance Aluminum, Consol Energy, which is coal, Alpha Metallurgical is also coal, Peabody is coal. So a little bit of hodgepodge there. So there's a couple of ways to use this. One is if you're looking at the ETF, you want to see what makes it up. Oh, I'll just quickly show you XLE, which is the oil energy index. And why I don't really like this one. I look at its holdings. 43% of this is Exxon or Chevron. So it's so heavily weighted with these that anything that happens within these companies can really move this particular ETF. So to me, I don't like it when they're heavily concentrated like that. So another way you can use this website is if the sector is moving, I'm not going to do it here today, but you take my word for it for now. But if the sector is moving, you can just click through these various companies and put them on your chart and see which ones are moving. You know, how is Exxon moving today versus Chevron versus Conoco versus Oxy and so on. So you could identify the hot stocks that are making an index move. This is more for active traders, but I, I don't use this feature very much, but I thought it was kind of cool. So that's that. And then what did I do today in my own, the other open positions? They're still trudging along. DIGI closed, it started off low, but then closed higher. So it's still having a good day. It's now had 1, 2, 3, 4, 5, 6, 7, 8 days of higher lows. So it's going to come into this 38.60 area, which is another 50 cents away. And then it's going to stall out a little bit. So I got to make a decision what to do, whether I take some off the table here or ride out a pullback and then hope that it rips up forward. ELF trudging up, but they have earnings coming up on November the 2nd. So this one's got to get going. I will not hold a stock over earnings unless I have a big cushion. I think DGII, let's go back there for a sec. They don't have earnings till November the 10th. So we've got 2 weeks or so before it'll make, you know, an impact there. With a 6% cushion, I might hold a half of this position over earnings, but I certainly wouldn't hold the whole thing. With ELF, I'm only up about 2.5%. And if it stays there by November the 2nd, I would have to kill it. I'm not willing to go into earnings with such a small cushion. LPLA, nice recovery today. This would have been buyable actually if I didn't already buy some more on Friday and have a somewhat overweight position. This break of this downtrend line is very positive. So I'm looking for this to test its all-time highs up here and then beyond. But again, they have earnings on October the 27th. So that's only in the afternoon. So that's 3 days away. So not much more we're going to get out of this thing before earnings. Added one new position today, a bank. Usually stay away from these, but I can't stay away from this pattern. If any of you again watch the videos on what to buy, this is the classic pattern that I'm looking for. On a daily chart, stock has moved up, it pulls back a bit, comes up, retests the high, pulls back again. This is a little steeper. I would prefer the pullback end right in here somewhere, but pull back, up, test the highs, pull back, not as quite as high, goes up, actually breaks out, but doesn't hold, but the pullback, assuming Friday's low on Friday holds, it's pulled back even less, and now this is poised to go. But the big problem with this one too is earnings are on this coming Thursday. So don't have a lot of time with this one, but who knows? So that's it. That's all. Better days looking. So time to get thinking a little bit more like putting your toe in the water and I'll help you try and find some things to buy. Cheers.